So let's talk about the hot topic, inflation. And how do we beat inflation? So on Friday, inflation came in worse than expected, right? It was 8.6%, which was above the 8.3% expected from the market. And it's the highest reading since 1981. So the market freaked out and the stock market tanked 3% on Friday. Now, core CPI, the bit of good news was that core CPI, which excludes food and energy. You may say, why would you exclude food and energy? It doesn't make sense. That makes the biggest part of our expenses, right? Well, the reason the Fed looks at core CPI is because they can't really control energy prices and food prices. So right now, oil and gas is what's driving inflation, but the Fed can't control that because that is coming from the war, and raising interest rates won't stop the war. At the same time, food prices are also escalating from the war, as well as the supply chain disruptions from China. So again, all that the Fed can't control, right? So because of that, they strip it out. They say, let's look at core CPI. So core CPI, that was a bit of good news. It's been going down the last 3 months, 6.5% in March, 6.2% in April, and now May 6%. So that's at least that's coming down, but big deal, all right? Who cares? Because energy and food is the main part of people's expenses, and that is still going up. And the Fed really can't do much about it right now. Now, so is this bad news? Yes, that's really bad news if you are holding cash. Because if you are holding cash, it's the riskiest investment to be in, because if you're holding cash, you're guaranteed to lose money. Now, it's not going to stay at 8% forever. It's going to come down, right? Maybe not to 2% for a while, but at least down to 4%. If you think about it, at a 4% inflation rate, that means the value of our money falls by 4% every single year, because our money buys less and less goods, right? So if you're losing 4%, 4%, 4%, 4%, if you compound that, that means every 10 years, you are losing 33% of your purchasing power, of your wealth. And in 20 years, you lose almost 40% of your wealth. Now that's at a 4% inflation rate. If it stays at 8%, which it won't, but if it stays at 8%, you lose 1/3 of your wealth every 5 years and 40% of your wealth every 10 years. And that's why, holding excess cash is the riskiest thing that you can ever do. Now, let me clarify. First of all, you need enough cash to pay your short-term expenses. So never invest your last dollar. Cash is like oxygen. You always need enough oxygen around. Without oxygen, you die. So you need to have enough cash for your short-term expenses of at least 6 months minimum. So I tell people, only invest the surplus that you don't need in the short term. Now, whenever I tell people that, cash is risky to hold, people say, are you nuts? Yes. If I hold cash, I'm down 8%. But if I hold stocks, I'm down 30%. That's even worse, right? Whole cryptocurrency, I'm down like freaking 50%. Isn't that worse? Yes. So understand that in the short term, in the very short term, when the market freaks out, if you hold stocks, it goes down more than if you hold cash. So it looks like cash is safer and stocks are riskier. That's what it looks like in the short term. But over time, you find that holding productive assets like businesses, like real estate, will beat inflation and will grow your wealth. And that's a guarantee, and it's happened for the last 120 years. Now, a lot of people think that, okay, so cash is losing value, I go into cryptocurrencies. And I've said many times, in my opinion, crypto is not the answer, because in the long run, the majority of crypto assets are worthless. They're all going to go to zero, right? So the only way to preserve your wealth and to beat inflation is, again, you have to hold productive assets, assets that generate cash flow, like real estate and businesses. And basically, when you buy stocks, you're buying pieces of businesses. And again, I repeat that again. Yes, in the short term, cash seems safer, because if I hold cash, it drops 8% inflation, but stocks drop 20-30%. Yes, in the short term. But over time, like I say, stocks or businesses will beat inflation by a long run. So we have to invest in businesses and real estate if we want to beat inflation, if we want to grow our wealth. So again, if you take a look at the longer term performance of businesses or the stock market, it outperforms any other asset class and it beats inflation. So if you look at the S&P 500, again, over a longer term period, over the last 30 years, you can see that despite the dot-com crash and despite the great financial crisis, despite the COVID crash, taking all that into account, you just hold it through those short-term ups and downs over the long run, you would have seen a capital gain of 1,346% of your cash, right? Now, if you analyze it, it's about 9.3% return a year, capital gain. Now, if you include the dividends, which is about 2.65% dividends, if you add it in, your total annual return is about 11.96% a year. So in other words, if you just hold the S&P index over the long run, you're getting about 11 to 12% a year with dividends reinvested. And that's way above even this 8% inflation rate. Now, how about other assets? Again, if you compare the S&P 500, the US stocks, it outperforms real estate and it outperforms gold as well. So again, businesses give the highest returns over the long run. So holding stocks are the best hedge against inflation. Now, some people say, but Adam, if that is true, why did stocks fall when we had high inflation data? Shouldn't stocks go up if stocks are good for holding in inflation? That doesn't make sense, right? Okay, so let me explain why in the short term the market tanked. So the reason stocks fall in the short term is because, number one, when we've got high inflation, it suggests higher business cost. So that means businesses, their costs increase. And when their costs increase, they've got lower profit margins. And that's why the market freaks out, lower profits, they sell stocks and market comes down. So is this true for all businesses? The answer is no. For businesses that are not able to raise their price easily because they are in a very competitive industry like auto industry, very competitive, airlines, very competitive, they can't raise their prices as easily. That's when their profit margin falls. That's when these businesses will start bleeding. And that is why we should only invest in companies that have got pricing power. So pricing power means that they are able to raise their prices to pass on the cost to their consumers. So if their costs go up, they raise prices, they maintain their profit margins. So what kind of companies have pricing power? These are companies that have a brand monopoly, a brand that people are willing to spend more on, like your Estee Lauder, your Nike, your Louis Vuitton, LVMH, your Apple products, for example. So only focus on stocks with pricing power. The second thing is this: as costs go up, raw materials costs go up and commodity costs go up, companies that have to spend a lot on capital expenditure to maintain their operations, they will suffer as well. So again, airlines, auto manufacturers, construction companies, they have to keep spending a lot of money to maintain their factories and their plants and machinery. So these are companies that would suffer from higher costs of doing business. So again, if we want to really beat inflation, buy companies that have pricing power, they can raise prices. And number two, they have low capital expenditure. They don't have to spend so much money to maintain their business model. For example, if you take a look at McDonald's and Domino's Pizza, they have got little or no capex because it's their franchisees that pay for opening the shops. They pay for the employees. McDonald's and Domino's, they just collect the franchise fees. They don't actually come up with the money to open the shops. Or look at technology companies like Microsoft, for example. Once they've got their infrastructure, they don't have to spend more and more on capex to maintain it, to raise their sales and profits. All right. The second reason why stocks fell on Friday is because higher inflation suggests that the Fed will have to raise interest rates faster. Now, is that bad for businesses? For some, yes, but not for all businesses. So what kind of businesses will suffer when interest rates rise? Answer: companies that don't make money now. So companies like, again, Roku and Peloton and Teladoc, a lot of the ARK Invest companies, they don't make money right now. They are hoping to make money in the future. in 5 to 10 years. So with these kind of companies, when you have high interest rates, you have to discount the future cash flow to present value. And with a higher discount rate, it lowers the present value of the future cash flows. In other words, it makes these companies worth a lot less today. So that's why I keep saying avoid companies that don't make money now. These are like the frogs that you kiss that you hope they turn into a prince, right? But these frogs are in trouble. They are boiling because of high interest rates. So we only want to own stocks that make money right now, that have got high profits and high free cash flow right now, because they are not as affected by high interest rates. Now, at the same time, people say, Adam, with higher interest rates, will companies with high debt, will they suffer? Well, yeah, in a way, right? Companies with a lot of debt, they have to pay more and more interest on their debt. That increases expenses. If they can't refinance the debt, they could go bust. But what is the meaning of too high debt or too low debt, right? It's a bit subjective. So what's more important is to look at the cost of debt. For companies that have a high cost of debt, you want to avoid them, right? Because they're in trouble. So how do we measure this? So what I look at is I want to look at what is known as return on invested capital. And I'll show you some numbers later. Every business has an ROIC, return on invested capital. It tells you how much money it generates from its capital. Now, as long as the ROIC is higher than the cost of debt, which together with cost of equity makes up the weighted average cost of capital, as long as ROIC is way higher than weighted average cost of capital, it's fine. The business will keep on performing well. Let me say, how would I know this, right? I'm going to show it to you in a short while. I'm going to show you 3 stocks that I think fit this criteria. So just hold on with me for a while. Okay, so what else? Why did stocks fall on Friday? Because of high inflation data. The other reason is that high inflation, especially high gas prices, oil prices, suggest that consumers, now they pay so much for gas, they've got less money to buy other stuff, right? So high inflation causes lower purchasing power and demand destruction, which means consumers now can't spend as much. And 70% of GDP, it comes from consumer spending. So that could tip the economy into a recession if oil prices keep going up. So again, is this bad for companies? Is this bad for stocks? Yes, of course, right? Because if people buy less goods and services, stock sales and profits will fall, the stock price will fall. So we want to own stocks that are essential to consumers and businesses. In other words, we want to own companies that are as recession-proof as possible. So even if there is a recession, people say, you know what, I don't have much money to spend on everything, but I still want to buy this because this is essential to me, okay? So what are the essential products that people have to spend on? Healthcare. Like it or not, if you're sick, you have to spend on your medical prosthetic arm, all right? You have to spend on drugs, medicine. So what kind of companies are essential? Healthcare companies. And that's why a big part of my portfolio is in healthcare businesses. Now, if you ask my wife, what's essential to you to spend on, she says, makeup, skincare, lipstick, I gotta have that, right? So even if times are bad, women would still spend on their face, and some men as well, right? So look at businesses like Estee Lauder, okay? What else? Like for me, I'm a professional investor, so I spend a lot of money on research tools. And one of the websites I subscribe to, or the services, is S&P Global, which is SPGI. And fund management companies and banks, they have to spend on research. So a company like SPGI, in a way, they are essential. People still have to use their services even during tough times. So let's summarize everything which I said. So what I'm saying is this, guys. Inflation is high, and it'll continue to be high for quite a while. And if we hold cash, we are going to guarantee our wealth will fall. So the only way to beat inflation is to own productive assets like real estate and businesses. And essentially stocks, when we buy stocks, we are buying pieces of businesses. And again, yes, in a short term, stocks could fall more than 8%. Yes, it could, because the market freaks out. But over time, in the next 1, 2, 3, 4, 5 years, I can guarantee you that stocks, businesses will outperform holding cash, right? Now, if you just hold the index, the S&P 500, it's good enough. You'll do really well. But if you want to beat the S&P, you get even higher returns than the S&P, then you want to hold businesses that have the following characteristics. So let me summarize. Number one, we want to own businesses that have high pricing power. So these are essentially brand monopolies that are able to raise prices to pass on the cost to their consumers, whether it's a Starbucks or McDonald's or Estee Lauder. They have pricing power, or Nike, for example, right? Or Apple, for example. But number two, we want to own businesses or stocks that require low capital expenditure to maintain their current operations. So we don't like businesses like airlines or auto manufacturers or construction companies that have to keep spending on more plant, machinery, and equipment to just maintain their cost efficiencies. Now, some people would ask me, Adam, how about Amazon? You said you like Amazon, but Amazon spends a lot on CapEx, doesn't it? Yes, but the difference is that Amazon spends a lot on CapEx for future growth, not to maintain current operations. So in other words, Amazon has a choice to cut their CapEx if they wanted to, right? But other companies don't have the choice. They have to spend on CapEx to maintain their business operations. The third thing is we only want to own businesses that are making money right now, that are generating tons of free cash flow, and their cash flow is increasing year after year after year. Next, we want to ensure that the business has a high return on invested capital, or we call it return on capital. Now, return on capital is the best way to tell if the company's stock is going to beat the market over time. And I'll show that to you more in a while, right? As long as the return on capital is greater than the weighted average cost of capital, which includes the cost of debt, then the business will be very, very successful. So we want the ROIC to be way higher than the WACC. And I'll show that to you in a while, so hold on, okay? Now, finally, like I said, with higher inflation, consumers now have less money to spend, or rather, they have got the same money, but their money buys less stuff, right? So now they have to choose what to buy after paying for gas, okay? So we want to own businesses that are as essential as possible to consumers, where consumers say, I have to buy this, right? I can't live without it, like makeup or healthcare, stuff like that. And these are the companies that will do well even if we get into a recession. So let me just show you 3 businesses that I believe meet my criteria. And disclaimer, I own these 3 businesses and I've been buying them consistently. And I'm using Guru Focus website to show the data because I think they've got great features on their website, right? So I don't get anything from them. I'm just sharing it because I use it every single day. So the first business, or the first stock which I own, which I've been adding, is S&P Global. Ticker symbol SPGI. Now, does it sound familiar? S&P, right? Yeah, so they own the S&P brand. So any ETF, any index that uses S&P has to pay them a franchise fee or a royalty, okay? And S&P, like Moody's, they give ratings to bonds. They do all these financial ratings, and they also offer a lot of research data. So for example, I subscribe to S&P as well. And all the professional fund managers and banks, they have to subscribe to S&P. So it's almost an essential service that we have to use. We have no choice. We got to use them. Okay. So number one, they have pricing power. They can raise their price whatever they want. We have to pay the price because it's like a freaking monopoly. Bastards. Right? But that's what they do, right? They have got little or no capital expenditure. So you get high pricing power, low capex. What else is essential? Okay, like I said, and they are making money right now. It's a cash generating machine. Now, if you take a look at their revenue, again, you can see their revenue consistently grows almost every single year. And it's almost recession proof. Well, how do you know? Take a look. The last recession was 2020. That was the last recession, and their sales increased in a recession. Their profits increased in a recession. So we want companies that are more or less recession proof like that, right? And take a look at their free cash flow, operating cash flow, again, generating free cash flow every single year, positive, making money right now. So these are the companies that will do well. Companies that don't make money, negative free cash flow, the price was up purely by speculation, by cheap money, the bubble has burst, they are not going to come back, right? So you got to only focus on these solid kind of companies. Now, the other thing which I talked about is that I only like to invest in businesses with high return on equity, return on capital. So one way is to look at the ROE as well as the ROIC. So ROIC means the return on invested capital. So what does that really mean, right? So for example, for this company, the current ROIC is 33.74%. What this means is that for every $100 that the company invests in capital, it makes $33 in profits. So think about it. You put in $100, you get $33. So the return on capital is 33%. That's really very, very good. So we want companies with ROIC as high as possible, preferably above 12%. So this is like 33%. In the long run, what has been found is that stock price performance tends to correlate to a company's return on capital. So in other words, if a company can return 30% on capital, their stock price would return 30% over the long run. And that's why ROIC is really, really important. Now, we talked about the cost of debt as well. A company borrows money, there's a cost of debt and a cost of equity. So together, it's called the weighted average cost of capital. So we want to make sure that the businesses that we buy, the ROIC is much bigger than the cost of capital. Okay. So in other words, if you look at SPGI, the return on capital is 33%, and the cost of capital, or WACC, is 7.5%. So in other words, this company makes a lot more money than the cost of their debt and equity. And that's how their share price is able to beat the market over the long run. All right. So here's one example for you right here, right now. Another example is Johnson & Johnson. Why? Essential, right? We have to use healthcare medical in any circumstances. Does it have pricing power? Yes, it's a brand where they can raise prices. They have got low capex to maintain current operations. They've got all these patents that they own, and they are profitable right now. So if you look at their revenue, you can see that revenue is growing consistently. Even during the recession, it's still growing. So again, essentially recession proof. Again, profits are growing consistently, and the company is a cash generating monster. Free cash flow increasing every single year together with operating cash flow. The return on invested capital, ROIC, the one in green, is way above the weighted average cost of capital. And for Johnson & Johnson, the ROIC is currently at 17.43%, which is extremely profitable as well. So a third example is one of my favorites, which I own in my portfolio as well, Microsoft. So needless to say, does it have pricing power? Yeah, it can raise prices. People still will use their services. It's essentially recession proof. People have to keep subscribing to their software from office or from home. And again, revenue is increasing consistently, profits increasing consistently, cash flow going up consistently. They have got a lot more cash than debt, and their weighted average cost of capital is very low. So the cost of borrowing money is very low for them, and their return on invested capital is over 30% as well. So these are just three of the great businesses that will beat inflation and beat the market over the long run that are in my portfolio. And again, there are many more out there. And again, if you don't know how to research on these companies, how to value these companies, then you got to take the value momentum investing course, or better still, subscribe to the Ultimate Investors Playbook, where I do all the research for you and you know exactly what are the companies to own that's going to build your wealth over the long run. Now, some people would say, but Adam, haven't you been listening? We are in a bear market, right? Recession is coming and you want to buy stocks. Are you nuts? Now, I'm going to talk about that in my next video. So in my next video, I'm going to talk about, okay, so this bear market that everyone's talking about, this recession, Is it happening? Is it going to happen? And is this a time to own stocks? Am I saying that it can't go lower? No, it could still go lower. No one can predict the bottom exactly because there are too many moving parts and variables. But what I'm saying is this: if you own good companies over time, 1 year from now, 5 years from now, it will beat inflation, it will beat holding cash, and it will grow your wealth. Now, finally, let me address this question. People have been asking me about, Adam, what if inflation keeps going up and we go into a recession and it's called stagflation? What happens then? Do we still want to own stocks in a stagflation environment? Yes. Well, let's take a look at the last time this happened, which was stagflation, where inflation went up to 12% in the US and then up 15%. And there was a time when the Fed had to raise interest rates to 12% and 20%. So you can't get worse than this. This is the nightmare doomsday scenario. So what happens if this scenario plays out? Well, you will see that it's still good to hold stocks, and it's the best thing to hold even in this doomsday scenario. Why? During this period, which was from 1970 to 1980, which was severe inflation, economy went into recession. We call that stagflation. If you held the S&P 500 and reinvested dividends, your total return during those 10 years would be 130%. Not bad for a doomsday scenario. If you annualize it, it's 7.89% return a year on average. Okay, now let me show you the next chart over here. So this is the S&P 500 with dividends being reinvested. So you can see that if you invested $100 in the S&P 500 at the beginning of 1970, at the end of 1980, which is about 10 years, you would have $230.60. This is a return on investment of 130%, or roughly 7.89% a year. Now, this is if you put everything in one lump sum at the start of 1970. If you did dollar cost averaging, which means you bought in consistently every month, you would have grown to $223, which is slightly less, but you still get a pretty good return. Now, this investment result beats inflation by about 8.5% for the 10 years, right? Or about 0.75% per year. Let me say, but that sucks. I'm only getting 0.75% per year. That sucks. Now, that is on top of inflation. So in other words, what I'm saying is this: if you're like most people who are so scared, you do not dare to invest, you just hold cash during this doomsday period. If you hold cash, you get 0% for the year, per year, right? But inflation is 7% a year. So in other words, every year that you hold cash, you're losing 7% in purchasing power. But if you hold the S&P, blindly just hold it through the ups and downs and ignore the short-term drops, you're getting 7.89% per year, which, yes, it's not that much greater, but at least you're beating inflation by 0.75%. At least you're maintaining your wealth and not losing your wealth. And that's why I keep saying that in the long run, the best hedge to inflation is owning productive assets. Be it real estate, you could own REITs as well, or by owning businesses through the stock market. Hope it's been useful, and I'll see you guys in the next video where I'll be talking about the so-called bear market and the so-called inevitable recession coming up. So subscribe if you have not yet subscribed, and I'll see you guys in the next video coming up really soon. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.